Happy Sunday, dividend growth stock investors. Colby, the DGI Crab here, and this is the weekly video where I go over each of the four tiers, a total of 60 stocks that this channel focuses on to see where the value in the market lies. In case you're new, I cover 60 individual growth stocks. They are split into four categories or tiers that are based off of the age and the time horizon of the investor, which I believe is the most important metric that a dividend growth stock investor should take into consideration. There are some interesting buying opportunities here. The S&P 500 is down for the week once again. And what I have noticed, if you'll compare what we're going to look at in this week's video to last week's video, there's actually fewer overall stocks in this group that are trading in the buy zone. So these stocks are doing pretty well for the most part compared to the overall S&P 500. There's been a pretty significant tech sell-off, and I'm excited to get into this one, you guys, because you're going to see some things that I have been purchasing that look like they are recovering. Hershey definitely looks like it is trending back up. Target crashing down. And is Microsoft a stock that is viable in my estimation right now? So we're going to get into all of that and more here today. Thank you for joining me. Now, I will preface everything by saying I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment, and the opinions expressed regarding investments are my own. You should always perform your own due diligence prior to investing your hard-earned money. For those of you who are new, I go over my DGI Crab allocation strategy so you know what my personal strategy is for investing. I put 50% at minimum of my new money each week into age-appropriate ETFs for automatic diversification. And then for individual single stocks, I am looking for a 30% or higher yield above their 4-year average yield. I have a group of top 10, just my personal favorite stocks. If they're yielding 20% or more above their 4-year average yield, I will go ahead and buy them regardless of what age tier they happen to be in, because I want to have a strong position in all 10 of those for my journey to financial freedom. I remain within my tier unless there happens to be a stock in a different age tier that's yielding 50% or more above their 4-year average yield, and then I'll go ahead and add to that position because I want to take advantage of the stock that's massively on sale in hopes that over the long term I get a lot of price appreciation and obviously a much higher starting yield. If there's not a buyable stock within my tier, I just simply add more to the ETFs that particular week. I'm not trying to time the market as far as that goes. I want to continue to put money into it regardless of how the single stocks are panning out. So we're going to take a look here at the DGI Crab spreadsheet. Pardon me. We're going to go through each of the four tiers. As always, we start with tier 1. Now, this group is for the 18 to 30-year-old investors where we are looking for starting yield 1 to 1.5%. Not anything too exciting in the starting yield, but what we're really looking for here in the exciting part of this group is we want a dividend annual increase rate comfortably above 10%. So we could get a strong dividend growth snowball for those of you younger investors that have a lot of time in the market to let those dividends compound. I've got these sorted by the valuation tab where I'm comparing the 4-year average yield, which I update every single Friday. And I compare that to the current day yield to see how far off those figures are. If the stocks are in the green, they've hit that 30% or more undervalued. If they're in the yellow, they're in the 20 to 29% undervalued range, which means they're not a terrible buy if it's something you're really looking to add to. And anything in the red, I'm not selling, I'm just holding, letting the dividends reinvest, letting those runners run, so to speak. So Nike and Nordson continue to be the two most undervalued stocks within the Tier 1 category. Both of them saw their 4-year average yield tick up 1 basis point. Doesn't do a lot to impact the overall valuation. Nordson was in that 50% or more undervalued last week, meaning that it was good enough for me to be added regardless of your age, unless maybe you're in your into your 50s and you really need to get a higher starting yield than about 1.5%. But these are both still looking pretty good. Nike's starting to show some signs of price recovery, but so long as they are yielding 2% or better, Nike's going to continue to be an attractive buying opportunity for me. United Health, definitely one of those stocks where it's just kind of jumping in and out of the buy zone as the price is under $500 per share right now. United Health, such a gigantic company, $450 billion by market cap, about as big of a player in the insurance industry as you are going to find. A lot of drama around that company, obviously, but hey, this is a pretty decent spot to buy them. I'd like to see their current yield be just a little bit higher, maybe a few dollars less. But if you're buying United Health in the low 490s, I certainly don't think that that is a bad idea. And then Microsoft. So Microsoft, these ones in the bold here are ones that are in my top 10 favorite stocks. Typically, what I do is I wait for a stock like Microsoft to yield 20% or more above the 4-year average yield. But Microsoft so seldomly even hits that mark that right now, because their current yield at 0.84% is higher than the 4-year average yield at 0.82%. If you want to be adding Microsoft right now, this seems like a pretty good opportunity to do so for me. Microsoft very consistently increases that dividend by around 10% year over year over year. There's been a tech sell-off, as I said at the start of the video. I think Microsoft is going to be such a major player in AI, quantum computing, all the exciting tech-related things that are coming down the pipeline over the next few years, that if you could get it right now while it's kind of down, I think you're making a pretty good play here. So I'm really liking Microsoft right now as well, even though it's not quite in my official buy zone. Sometimes with a quality stock like Microsoft, you just got to strike when it's fair priced. Warren Buffett said you'd rather buy a great company at a fair value than a fair company at a great value. And this is a great opportunity to do that with Microsoft. Tier 2, age 31 to 41, where we're looking for starting yield more in the 2.5–3% range. And we want an annual dividend growth rate between 7 and 9%. So a little bit higher starting yield, not quite as high of a growth rate year over year. As you get a little bit older, you want to start adding a little bit higher starting yield. Target has absolutely raced into the top position here at 59% undervalued. There are consumer boycotts going on right now. Target is getting hit. Honestly, I think both from left-wing and right-wing political activists, they just cannot seem to make anyone happy right now. It doesn't really do much of anything to impact how I feel about the company or adding to my dividend income. Right now, I feel pretty comfortable adding Target at a starting yield of nearly 4%. I think Target is eventually going to pull through with this. They're a dividend king, which means 50 plus years of consecutive dividend increases. So I'll take the higher starting yield right now and wait for the recovery. Hershey, hey, this has been the number one stock as far as undervaluation goes here in Tier 2 for quite a while now. I've been adding a lot to Hershey. I'm still adding to it, even here in the 180s, but it is nice to see Hershey recovering a little bit. Starting yield has dropped back below 3%. I was buying this at well above a 3.5% yield at times over the last few months. And then NextEra Energy, still very happy to add this utility here in the low 70s. I'm getting a starting yield above 3% when the 4-year average yield is 2.37. Very happy to add on to NextEra Energy once again this week. Tier 3, 42 to 53-year-old investors. We're looking for 3 to 4% starting yield. And we want an annual dividend growth rate in the 5 to 7% range here. Archer Daniels Midland and Hormel continue to be the two dogs in this category. Archer Daniels Midland yielding above 4% for me is a no-brainer. Another dividend king. Hormel, dividend king. These companies have been through hard times before. I'm confident they are going to get through hard times once again. Nice way to add good high starting yield here in the 42 to 53-year-old range. And then Pepsi, one of my top 10 favorite dividend growth stocks, yielding 3.5%, 26% undervalued. I am still all about adding Pepsi. Well, it's down here in the 150s. And then T. Rowe Price dropping below $100 a share at times here, yielding above 5%. T. Rowe Price is one of the poorest performing stocks in my portfolio. This was one before I locked into my strategy. I bought a few years ago when it was in like the $150 range, and I've been just doing dividend reinvestment and writing that all the way down. I'm a little leery here of T. Rowe Price. It's going to have to continue to get even cheaper because that 4-year average yield has done nothing but climb and climb and climb over the last couple of years, and the dividend increases, while they've kept their streak alive, just haven't been great. But You get that starting yield above 5%, and you're confident in T. Rowe Price eventually turning it around and getting those dividend increases back up to where they used to be. This could be a good buying opportunity for them as well. I'm staying away for right now. Let me know what you think about T. Rowe Price down there in the comments below, y'all. Tier 4, age 54 and older investors, we want starting yield 5.5%, 6% if we can get it. Still want dividends to grow year over year in that 2 to 4% range to keep up with inflation. Still nothing in this category. The high yield stocks are just doing a good solid job right now. Verizon a few weeks ago, or maybe it was a couple months ago now, was starting to edge into the buy zone, and then it has just shot up. AT&T is not one of the stocks that this channel focuses on, but it's doing pretty well also. Not a bad time for telecom, but nothing in here jumps out at me as something that should be an immediate add. So this group of stocks, or this tier of investor, is probably going to be doing ETF double down. Quick swing by the top 10. These are all stocks that are located somewhere between tiers 1, 2, or 3. Pepsi is the one that's in the buy zone, but as I said before, I am all about adding Microsoft right now, with the current yield being above the 4-year average. I just think Microsoft is such a great company, such a great stock. If you wait for it to be too cheap, you may be waiting forever. So the strategy for the different tiers, I like to do ETFs. Like I said, at least half the money goes into ETFs. If I'm in tier 1, I'm doing 25% of my money in the S&P 500. I'm going to pick a small cap value ETF for about 15% so I can get exposure to that. Good time to add to a dividend appreciation fund like VIG. You can start trickling 5% in there to get the ball rolling. And then I do VYMI for my international dividend exposure. 5% across the board, all age tiers. VYMI, if you saw my video yesterday, the great ETF race, VYMI is crushing it right now. Tier 2, same 4 ETFs, different allocation. Dividend appreciation gets the bulk. S&P 500 and small cap still there, but just not as much. And then tier 3, SCHD, VYM, DHS, 3 great dividend-focused ETFs. SCHDs perform the best, so I'd probably be allocating the most there, but VYM and DHS also are excellent ETFs. And then for tier 4, you got SPYD for high yield stock exposure, and then alternate investments with high yield that you probably haven't been buying up to this point, but when you get into your mid-50s, it's not a bad idea to start diversifying into some of this high-yielding stuff like high-yield bonds, preferred shares, MLPs, covered call ETFs, Devo, JEPQ, SPY, my top 3 in that particular category. And then for the stock allocation, so let's talk through this, you guys. Tier 1, we know Nike and Nordson, still undervalued in the tier 1, so I'm going to do 10% each if I'm a tier 1 investor into those. I'm also going to do 10% into Microsoft to just take advantage of that deal while it's there. I'm going to do 10% into Pepsi because it's a top 10 favorite in my buy zone. And then I'm going to reach up into tiers 2 and 3 respectively with Target and Archer Daniels Midland, both 50% or more undervalued, so I'll start adding a little bit into those. Tier 2, I'm going to grab Target, Hershey, NextEra Energy, the undervalued stocks in my tier. I'm going to grab that top 10 favorite with Pepsi, reach up into tier 3 for Archer Daniels Midland, and reach down into tier 1 for Nike. And then for tier 3, Pepsi, ADM, Hormel, that covers the undervalued stocks in my age tier. And I am going to grab Target and Nike as well in tier 3, reaching down into those tier 1 and tier 2s. And then for the tier 4 guys, so listen, I double down on the ETFs in tier 4 all the way across the board. Instead of 15 and 5s, 30% and 10s, all the way down. I don't double down into international investments. I keep that at 5%. So there'd be 5% left over. And this time the stock that I would pick would actually be Target. I'm getting a nearly 4% starting yield on that. That's not too bad for you current income seekers. And I do think that over the long haul, Target is going to continue to increase their dividend, hopefully by more than just 1%, 2% like they've done the last couple of years. I think they'll get back to being a good growth machine. And then finally, the DGI Crab channel portfolio. I had $100 a week into this portfolio at minimum. It's shaping up pretty well right now. It's about break even, but the biggest gainer right now is Hershey. $25 up on that Hershey position. That's why you add to this stuff while it's down, you guys. So you pause the video and take a look at these holdings and see how I'm doing. running out of time here, so I will see you all next week. Thank you so much for tuning in and keep investing.